Okay, for this section's material, we are going to need the handout that the first tab on what I have labeled as number 31.5. It actually has two tabs on it though, 30.5, and then the one that we're going to practice on further in class is the 31.5, the actual next year. So the one we're going to do later in class is the 2015 to 2016 year. This one is simply the 2014 to 2015 year, so the year prior. We're going to be looking at something that's, some of these are going to be important from the company standpoint if you're a small business owner, to see how much, how practical, how relevant your company is, how well you can pay debt, how well you're doing just overall. And then the bottom few that we're going to look at are going to be more of an investing section, to see which type of stocks would you may want to invest in, or which companies look the best, and what stock investors are going to look for. First thing to point out here is you'll need to have this one up, this financial statement up, because we're going to be going through it quite a bit. One of the things to note when we're talking about ratios is we can't compare every single company against somebody else. When you have different types of companies, they're going to have different normal ratios. What's normal for a company like Walmart very well may not be the same normal as for somebody like Amazon or eBay. And I'm going to show you a lot of those comparisons as we go through. I've went through and researched what each company's ratio that we're going to look at, what theirs are at, just by going into their financial statements. You can easily find those, or you can just simply Google it and it'll come up pretty easily. It's pretty easy to find. Okay, so as I said, we're going to be looking at the year 2015, looking at the income statement and the balance sheet, and then I have 2014 up here because we will have a couple averages to use, and the averages will be whatever the beginning of the year is plus the end of the year, and then divide it by 2. That's how we're going to find the average on a couple of these. Okay, so the first ratio that a lot of companies are concerned with, and something that every business owner or accountant should know, is what is a current ratio. And that's simply your current assets over your current liabilities, meaning how are you able to pay off your current debts? If your answer to this equation is 1 or above, then you have more assets than current liabilities, and you should be able to pay off most of your debts when they come due. So that's what I'm having here, ability to pay off debts. A low current ratio means you may or may, anything under 1 means you have more debt than you do than current assets to pay those debts. So you may struggle at times to perhaps meet payroll, to perhaps meet a due date for a bill. But just then, on the opposite side, anything perhaps over 3, and this is just an average, it doesn't necessarily mean this is the same for every company. But if your current assets are over 3, then maybe you have too many current assets and not enough debt. So meaning you could have more debt out there to potentially make your business bigger and better, because debt isn't always a bad thing, especially when you're trying to grow your company. So I went through and I gathered up some of the items from, some of the numbers from just certain companies, and I'm going to compare these as we go through. I'm always going to have, or try to, the same companies show up every time. So I looked at Amazon, and on Amazon I'm going to show you this year and last year on each of these, and then all the other companies, just what they are this year. So Amazon, you can see they don't change very much, and that's the same with a lot of companies. They're just over 1, so that's good. They can typically pay off most of their debt when it comes due. And as you can see, most of the companies here are right around the 1 number, which is pretty common. eBay, as we'll find throughout all of our exercises, is the outlier type company, and it wouldn't want to compare to somebody like Walmart just because they're a lot different, and they're going to have a higher amount just due to different things. They don't, for whatever reason, they have a lot more assets than they do liabilities. And we'd have to really dig into their financials to determine why that is and what causes that. But now what I want you to do is try it for our company. go through and add up for 2015 all of the current assets, and then divide it by all the current liabilities for 2015. So for each of these, there's 10 of them that we're going to go through. I'm going to have you pause each time and then calculate it and see if you happen to match what I do. All right, so go ahead and pause, and then we'll look at the answer. All right, when you add up all of your current assets, if you take cash all the way through inventory, you should get $123,000. And then we're going to divide that by our current liabilities, accounts payable and wages payable. So my company is more of an outlier, kind of like eBay. I have a pretty high current ratio, which is good. For every $2 of assets I own, I only owe $1 of liabilities. That's nice. Now, current ratio, the only drawback to the current ratio is notice it includes all current assets, even these items that we may not be able to turn into cash at all, or if we can, not necessarily as quickly as simply collecting on a debt from an AR. So what the next ratio does is it eliminates the items that are hard to get money quickly, especially like prepaids. And then not so much, but again, inventory, if you have to do a quick sale, you may not get the full amount that you think you could. Maybe not what the inventory is worth. You always hope to sell your inventory more than what it is on here. But still, if you had to sell it really quickly, you may not even be able to get that. So what this current ratio does, it says, okay, with just your cash and your almost cash, like AR, how much can you really pay on your current debt? Are you still above 1, like you should have been with the current ratio? And as you'll see when we look at these items, they are nowhere near 1. Amazon drops, not significantly, from just over 1 to only 0.74, so not too bad. But when you compare that to Lowe's and all these other companies, they're well low. They're well below 0. Or well below 1. It's going to be hard for Lowe's to pay on its current debt. It only has 7 cents for every $1 of debt. That's not a real good ratio. Whereas eBay, they're doing still quite well. They're still over 2 when they take out inventory and prepaids. So what I want you to do is do our company, and let's compare. How is our company doing on the quick ratio? Let's go ahead and pause and do that quick calculation. All right, so our assets, they go from 123 before, now they're only at 86,000. Our liabilities remain the same. We don't remove any of those. So we're still at 62,000. So now 86 divided by 62. Now we're much lower, but still we're able to pay our debt. We have $1.39 in assets for every $1 of liabilities. So those are 2 very common ratios that a lot of companies will look at to see how you're doing, and if you're able to pay debt. A lot of banks will look at this too, but before making you a loan. Okay, inventory turnover. All companies, if you sell inventory, it's best if you can turn your inventory over as quick as possible. You don't want the same items just lounging and staying in your store for months on end. You want to sell it and then buy new and sell it again. The more times you sell, the more profit you're going to make. So your inventory turnover is pretty important. We want to know, do we turn over our entire inventory only once a year? Maybe 4 times a year? 10 times a year? If it's something like milk, you may do it every other day. So that's almost 200 times a year. So it all depends on your product, but still, the higher the number, the better. So I'm looking at a couple of companies here. I first pulled up Walmart just to show you that Walmart, they turn over their inventory, and I'm not sure why my screen did that. Walmart turns over its inventory 8 times a year, or if you're looking at it on a daily count, that means every 46 days. However much Walmart has in its store, they completely sell everything and then start up again. Now that doesn't mean they sell every single item 8 times a year, Some of the items they're only going to sell maybe 4 times a year, but things like milk and bread, they sell 150 times a year. So it's on average that Walmart will turn over its inventory 8 times a year. And how we do that, take our cost of goods sold, how much are you selling in a year, divided by how much do you have on hand on average. So a real easy formula. So here, Walmart, how I got this number of 8 times, I simply took the 358 billion in cost of goods sold, divided it by what I calculated their average inventory to be, 44.9 billion. When you do that simple division, you're going to get a little bit over 8. We look at Amazon. Notice Amazon is at 7, so they're pretty close to what Walmart is. Lowe's, Walmart, here's Costco. They turn it over even more, because I'm guessing because they sell in big bulks. So that makes sense. So now what I want you to do is, for our company, determine what our inventory turnover is. How often am I turning it over? How many times in a year? Okay, what I want to do for this one is I want to look at my cost of goods sold, 210,000, that's how much in inventory I'm selling a year, divided by the average of my inventory that I have on stock. So the average here, you can just look at it and get the average of 25,000. But if it's not so easy, in a future case, all you do is add up last year's plus this year's and then divide by 2. So 50,000 divided by 2. And when I do that, I get that we turn everything over very similar to how Walmart does at 8.4 times. Now, what I have for the next item is simply, if I turn it over 8.4 times, in days, how many days does it take me to turn it over? So all I simply do is take 365 days divided by my turnover number, and that's going to tell me that every 43 days, my inventory turns over. So that's pretty good. That's just a little over every month. My next ratio that I wanted us to look at is the account receivable turnover. This is, if I have $100 in debt on average, how often am I collecting that 100? Do I collect it only twice a year? That's not very good. Or am I collecting it at least every month? That would be good. So a number like 12 in this kind of an answer would be a really nice number to have, because at least you're collecting your debt, all of it, every month. So maybe more realistic is a 6 number. Hopefully you're collecting it at least by every other month. You're totally collecting your debt and moving on to new people's debt and then collecting theirs within 2 months. So how we do this, net credit sales, I tell us in our problems here that of the total sales of 400,000, 50% are on credit, because I don't want to use the total sales, because of those that came in cash, that doesn't help me determine how fast my AR comes in if they just came in cash right away. So I want to use my actual sales on credit, and then as I did with the inventory, divide that by the average AR. So let's look at a couple companies and then we'll look at the answer. So Amazon, they turn their stuff over really well. They turn it over 20 times a year, so that's well over that 12. So it's almost every 2 weeks they collect on their debt, on the debt that's owed to them. As you can see, their net sales. Now this number may be high. Notice here I took their net sales. It was hard for me to find exactly how much was sold on credit versus not. So maybe if this was half, then that brings this down closer to what it should be. But I think on this one, I took it from perhaps their company website. So that's kind of where I got these numbers. So I'm guessing that maybe perhaps most of their sales are on credit. I don't know. But that was the number given, and these also are the numbers given on these specific companies' websites. If you actually go into their financials, it'll tell you what their AR turnover is. Costco does really well. They turn theirs over every 92. They turn theirs over 92 times a year, so that's about every 4 days they collect on their debt. So not sure how that's hardly possible, but More realistic here is eBay, every 15 times a year. So go ahead and do that for our company and see what you get. Pause it, and then do the 4B. How many days does it take? All right, so for 4A and 4B, my company, we turn our AR over 4.82 times a year, so almost 5. If you do that, that means I'm collecting on all of my debt every 76 days, which isn't great, but could be worse. So that's basically every 2.5 months, I'm collecting on my AR debt. All right, the next one here, gross profit margin. Remember, our just like what we were doing in our class, we were talking about contribution margin here in 102. The sales minus variable cost. Well, if you think back to 101, sales minus cost of goods sold is our gross profit. So that means just based on the inventory alone, no other expenses, how much am I making on every dollar that I sell of inventory? So that's what this gross profit margin, almost the exact same as our contribution margin. Same way to calculate it. Whatever our gross profit turns out to be divided by our net sales. So Amazon, their gross profit margin stayed relatively the same. The 2 years, 35, 33%. And then you can see eBay again, the outlier. For every dollar they bring in, 77 cents goes to their bottom line. That's because eBay doesn't have a whole lot of inventory, so their cost of goods sold wouldn't be very high. Most of their expenses are going to come from normal, like website maintenance and paying payroll. It's kind of like a service business almost. They don't have a lot of their own inventory. People like me sell it to somebody like you. They're just the middleman. Other companies that have a lot of inventory, this is a pretty common number to look at. If you compare your company, it's nice to look at other companies and see where they're at. So for every dollar that Walmart brings in, almost a quarter of it goes to their profit, whereas Costco doesn't do nearly as well. So Costco may be the best option from a consumer standpoint. They're not going to make very much on a per item basis. So they have to sell a whole lot to make up more money. I went ahead and did our company here. It's pretty easy. Take the 190,000 divided by our net sales in total. So for every dollar I bring in, 47.5 cents is added to profit. Okay, the next one is almost identical to the one we just did, except instead of looking at gross profit margin, now we're going to look at operating profit. Operating profit is almost the same as net income. If you'll notice though, down here, net income is our bottom line, but that includes things like income tax and losses. So when a lot of times if you're evaluating a company, businesses, banks, or perhaps people in the stock market, you'll look at, well, what do they do on a day-by-day basis, not counting things that are somewhat out of their control, like income tax. On a day-by-day basis, they're going to bring in $101,000 in income. So that's what this item does. It avoids this big loss or gain potential, because a company could have a weird year and have a big loss. They sold a piece of equipment, or a big gain, and that's going to skew the net income. But if you simply look at their beginning number, what was their day-to-day stuff, this is going to be a nice realistic number to use, the 101,000. So that's why we're doing that instead of net income margin ratio. We could do net income. It would be it's another good one to use, but I prefer the operating profit. Notice here Amazon's is pretty low. They only make 3 cents on the dollar. So every dollar of sales that come into Amazon's website, 3 cents goes to their bottom line. Whereas eBay makes quite a bit more. Walmart, these companies down here, when they sell in mass, they have to, because they don't make very much on a per sale item. So they have to sell a whole lot to get their net income up to where it needs to be. if you only make a nickel on every dollar of sales. You're gonna have to sell a lot more than somebody like eBay. So with our company, it took 101,000 divided by our net sales of 400,000 to get. Our company is very similar to eBay here. We make 25.25%. So a quarter of every dollar that comes in goes to our bottom line, which is good news. So the reason big reasons here is eBay. If you looked at eBay's if you looked at just their net income, profit, their ratio would have been 80% for 2016, which included a large gain that they had. But when you compare it to 2015, it's way back down to 20%. So that's why there's such big fluctuations here. As an investor, you like just small trends, not big jumps and spikes every now and then, because then it's hard to gauge how well the company's doing. All right, rate of return on total assets. We got 4 more to do here, 7, 8, 9, and 10. So our rate of return is, if I'm buying assets, is it doing my company any good? If I keep adding buildings and equipment, I hope that those buildings and equipment are turning around and making me money. That's what this item does, rate of return on total assets. If I have a whole bunch of total assets, hopefully I'm making money on those. So I want to see, what's that return going to be? So for every dollar that Amazon has in assets, they make 2 cents more in net income. So if they add $1, they're going to add 2 cents in income. Year to year, that begins to add up, especially if your assets are long-lived. Maybe they live, if it's buildings, they may go 40, 50 years. Machines, not so well. They only maybe last 10 years or maybe a little more. As you can see, in 2015, they didn't do nearly as well. They barely made a penny for every dollar of assets they had. Whereas these other companies are right around the 7 to 10% range, except Netflix is on the low end. They do have a lot of assets. They now own a lot of production sets, because they make their own videos now, movies and shows. So theirs will continue to build, but right now they have a whole bunch of assets to take care of. Now go ahead and do that for our company. Look at our actual net income and divide it by our average total assets. The hardest part with this one is to go ahead and add up our total assets. I don't actually give it to you. So you would need to go through for 2015 and add up everything in the asset column. So that would be the piece that would take you the longest. Of course, subtracting out our accumulated depreciations. When you do all that, you should get 80 average of 341,000 on 2014, plus, because we're doing the average, so we got to do both of these, plus 296, get the average, so divided by 2, and then using 80,000 as our numerator. Where does that leave us? Our company, we do really, really well, kind of like eBay. For every dollar we invest, a quarter goes into our net income. So after 4 years, I'm making money on those assets. I'm recouping all of that as additional income. Earnings per share. This is something we did in Accounting 101, so hopefully you remember a little bit of this. This is simply says, best case scenario, how much in dividends will my common stockholders get? So best case scenario says if all of our net income is distributed less whatever goes to preferred stocks, how much am I going to get on an average basis for each share of common stock? And so I have to tell you this stuff, and I do towards the bottom. Of course, you have your net income. I tell us that we have no preferred stocks. We don't have to worry about those dividends. And then I finally tell us how much in outstanding shares we have, 5,000 shares. So we can see then, if I gave out all my net income to my owners instead of reinvesting it in the company, how much is going to be given on a per share basis. So go ahead and figure that up and see what you get. Okay, so I took 80,000 minus 0 and divided it by 5,000 shares. What that comes out to be is $16 a share. And then I compare to these other companies, and I'm doing really well. Best case scenario. Amazon, they don't give out dividends, so that's what they have to use to be able to compare to other companies. If you go to Amazon and you buy Amazon stock, you're not going to get any dividends. They reinvest everything they earn back into the company. And then the hope is that they'll continue to grow and grow, so the stock value will continue to grow and grow. And then you can sell your stock to make money instead of getting it on dividends. So on a per case basis here, they went way up for 2016. Who knows why? Maybe they bought back some stock. Maybe they had a much higher net income. We don't know by not doing any other digging in. But this year's was pretty comparable to Lowe's, Southwest. The other two companies were a little bit higher. Not nearly as good as mine, though. All right, our last two. The first one is dividend yield. What this is telling investors is if you are concerned with dividends, how much are you getting based on the price of the stock? So if the stock cost you $100, but you're only getting $1 per year, that's not good. That's only a 1% yield. Whereas if the stock costs $10 and you're getting $1 a year, then that's not nearly as bad. You're getting a 10% return. That's what this is looking at. How much in annual dividends per year is given out over the average market price or the price that you paid. And so I give us that in this information here. I tell us that the dividends is $2.60 on a per share basis, while people paid $50 to get this stock. So on a year-to-year basis, what is the return? This one's pretty easy to go ahead and calculate as well. 5.2%. When you compare that to the other companies that I have here, my company did really well. But we're always going to want to look at how is the company we're looking to invest in compared to others. Of course, you look at Amazon and it's 0. They don't give out any dividends. Whereas Southwest, on a per share basis, they only gave out 37.5 cents. That's not that great compared to what the price of the stock was, probably in the range of around 38, 40 bucks. So you're not getting much of a return. Finally, price earnings ratio. This is something also that investors will look at. They're going to compare what am I paying for the stock divided by how much, what is the number 8 here, best case scenario. Best case scenario. So the lower the answer, the better. And what I mean is if this market price is 50 bucks and best case scenario is you only get $1 per share, so that's 50. What's what the number would come out to, 50 divided by 1. Whereas if this was only $25 per share and you were only getting $1 back, well, then that's better because it's lower. 25 over 1 would be 25. So this is illustrating here what the market is willing to pay for a stock. That's what this price earnings ratio is. The better, the lower, the better. Notice Amazon's really high figure, 234. Because as of the date when I looked these up, which was still a while ago, I know, but this will be an okay for a while number. They were trading currently at over $1,100 per share, and then not giving out. Then dividing that by their best case scenario was $3.93. But again, they don't pay out anything. But still, best case scenario. That's why that number is so high. Looking at their market price, 1130, divided by that price earnings, that earnings per share. I give a couple others here. eBay, a lot more realistic, 18 instead of 234. Walmart, it's at 20. So you can see where most of the other companies lie, between the $15 and $30 range. Whereas my company, I'm a lot lower, way down to $3, not $3, but 3.13. All right, we're going to stop it there. We're going to end here. This is our part 1 section, but for most semesters, we will end here at part 1 and not get into part 2. I will tell you differently in class if we do have time to get into part 2.